The ABCD pattern begins to form with a regular 0.618 Fibonacci retracement, where point C retraces 0.618, or in other words, 61.8% the distance traveled from A to B. Then the distance from point C to D is 1.27 or 127% the distance from B to C. So basically, a 1.272 extension of the range covered from B to C. Then at point D, the chances of a reversal are higher, as shown by these real-world chart examples, where it would of course be incredibly rare to get those exact 0.618 and 1.272 proportions. That's why some people literally choose to broaden the criteria so that point C can form in a range from 0.618 to 0.786, and point D can be in a range from 1.272 all the way to 1.618, while others may choose a middle ground by having proportions that are plus or minus 5% from 0.618 and 1.272. Harmonic patterns like this don't take into account the x-axis of time. However, a desired quality is to be able to have a Fibonacci time zone based on the interval from point A to B, then have the next time zone lines be aligned with points C and D, or very close to them. This is not necessary, but a bonus feature for more validity, if you will. More simple and common confluence can be aligning with an established resistance or support area, and to have reversal candles form around that range. Such features are more common compared to alignment with Fibonacci time zone lines. And as seen with this broad range of examples, the ABCD pattern can be found across various markets and time ranges. Here's an example from the S&P 500 stock market index, which is quite good for demonstration purposes. Because since stocks generally follow a major index like this, these general movements can be found across more stock charts around the same approximate time range. And you may have noticed even if there's no major reversal, price will often at least reverse from point D back to around the range of point C. And while broadening the criteria for the pattern, we'll see it appear more often being too loose with the criteria can naturally result in less reliability. Such as in this case where price does stall but does not reverse after point D. A less reliable pattern can also mean a reversal does take place around point D, but it's a smaller reversal and doesn't get back towards the range of point C. And of course, it's better to have proportions close to both 0.618 and 1.272 rather than just meeting one of the criteria. So there you have it, the ABCD pattern. Keep it simple with strict criteria for higher reliability. For more on stocks and crypto, follow Ascencore. Thanks for watching and have a nice day.